It's a little less windy. Todd Schoenberger joins us right now from Land Coal Trading. He's down in Wilmington, Delaware. Always good to talk with Todd. How you doing, Todd?
I'm doing great. Thanks for having me.
What do you think about today's action? Just a matter of, as we were saying, up 7 days in a row. Yesterday, we were down 100-plus points at one point in time yesterday, and we were able to stave off the sell-off, if you will. But, now we're talking about, is this what we almost had yesterday finally coming to fruition?
Yeah, I think so, Chris. I mean, I think this is probably the start of a sell-off for the rest of the summer, actually.
Wow.
There's just too many headwinds that are out there right now. When you look at the economy, you have some economic data that is actually poor. Obviously, employment remains a dismal picture. So with that said, no matter what we see in earnings, I mean, just the slight blip in earnings right now is probably going to cause a sell-off, and we see that today.
What do you make of earnings so far? It seemed like we got off on the good foot here with Alcoa surprised us. You had Intel surprising us. Even J.P. Morgan Chase had a pretty good number compared to what we were expecting from banks, but it seems like over the last 24 hours we've taken a turn for the worse.
Yeah, you're right. I mean, the banks, actually, the earnings so far have been decent, but when you look at J.P. Morgan, probably the only underlying theme in that whole report was really the late payments from prime mortgage holders.
Yeah.
When you start looking at that, that really can be a proxy, can send a signal that the overall economy is not improving the way that a lot of us would hope it would.
Yeah, but I mean, hey, why aren't the markets interpreting the fact that we've got a Goldman SEC settlement, we've got a plug for the leak down at BP,
Yeah.
Down in Louisiana? You would think with all of these situations that have been, put so much uncertainty in the markets for so long, you'd think putting those behind us, we'd be rallying today, but we're not.
Well, you bring up the key word there with certainty, and I still think that there's a tremendous amount of uncertainty out there. I mean, just because we have a couple of things, we plugged the leak, which is great, by the way. It's just fantastic for that entire region. But ultimately, though, we still have a lot of cleanup to do. We still have an economic mess that's taking place in the Gulf as well as the rest of the country. And then also, remember, quarterly earnings, when you look at these report cards, they're past-looking. I mean, you're looking at the past 3 months, and the forward-looking outlook is really what's key. And overall, even J.P. Morgan came out. Jamie Dimon, of all people, the most optimist of all people on Wall Street, even came out and warned that maybe the immediate future is not as rosy as we would like to believe.
What do you make of BP? It really has been rallying over the last couple of weeks, going from $27 a share up to trading at around $38 a share even this morning, up on this news. Is this a lottery ticket? Is it too late to jump in, you think? If you think, all right, all is well, in a month they're going to bury this thing and move on?
Well, those people are gambling. I mean, it's great that it had a brief run-up right now, but ultimately, though, if you're going to invest in BP, you're just simply gambling. I mean, there's a couple of things here. They are clearly a takeover target. I mean, this is a company that on April 20th, when that rig exploded, the company only had a little over $8 billion in cash on its balance sheet. It had a $13 billion line of credit, but after all is said and done, you're going to be looking at tens of billions of dollars in liability costs for the company. Ultimately, their most prized asset are the franchises, those service stations. They have almost 23,000 of them out there. And no wonder ExxonMobil would like to look at this company and maybe buy them. They could care less about the exploration activities. They're just as toxic as those fumes up in the Gulf. But ultimately, though, it's those franchise fees that a bigger oil company probably wants.
Hey, Todd, changing the tune just a bit here today, something else that's on our radar is watching the U.S. dollar. We talk about how we continue to see more weak economic data coming in, and the dollar today actually is trading its lowest levels against the yen so far in 2010, and also Goldman Sachs has now changed its tune, saying the dollar is going to weaken into January. I'd be curious, from your standpoint, how do you invest, how do you trade that sort of situation if we do continue to see a weaker U.S. dollar? Buy multinationals, big Dow components?
Yeah, well, you can, but what I would look at is a couple of things. One, clearly a weaker dollar, you have to look at some of the industries that are out there that will do well. One is actually travel and leisure. I mean, of all indices that are out there, this is a big favorite of mine. I mean, it's up over 10% for the year. It's clearly beating off the broader indices. But when you start looking at the components there, the hotels, the airlines, they've done tremendously well, and it seems that they're continuing to do tremendously well, only because you do have a weaker dollar that is out there. Ultimately, though, when you look at at international indices, maybe the Nikkei, for example, it took a killing yesterday. It was down almost 3% off of those yen-dollar concerns that are there, and obviously exporters, plus there was a little bit of profit taking. But ultimately, though, I think if you're going to look at one key sector, travel and leisure might be the one for investors right now.
What's your favorite in that space, Todd?
Hyatt Hotels. I love Hyatt. You know, when you think of Hyatt, I mean, they have all these, the Grand Hyatt, obviously, in New York, and you got your Park Hyatts that are out there. They're doing great. But it's all these little smaller ones. They took over AmeriSuites hotels years ago. They now have this chain called Hyatt Place. They're all over the place, these things, and they're great. They're inexpensive, they're clean, they're wonderful to go to, the service is excellent. I'm a big fan of Hyatt right now. The stock's up over 20% this year, and out of any of them, I mean, if you think of any of the hotels that are out there, Hyatt seems to be the most consistent earner right now, especially when you start looking at their month-over-month vacancy rates. They do extremely well. They're usually booked most of the time. So I would recommend Hyatt to any investors out there.
I know. I always get confused when I see all these different hotel chains between the Hilton, the Hyatt, the Grand Hyatt. I guess I'd also want to know, on a day that we're seeing the Dow down over 200 points right now, this is an opportunity where those who think they've missed maybe the rally here, they might start looking at some stocks today. What else are you looking at?
Well, a couple of things. I mean, I love Google. I'm kind of surprised that Google is actually going to take a hit right now. And if anything, investors may want to, I know it's pricey as far as for your normal retail investor it's out there, but if you're looking to establish a position, I would actually look into the weakness right now. I mean, a couple of things. Here's a company that actually had, if you look at their overall numbers, their operating margins went down quarter over quarter, went from 37% to 35%. Still very healthy, but the reason why their operating margins went down is because they hired so many people. They lifted their payrolls actually quite a bit quarter over quarter. So that gives me reason to believe that here's a company that overall in the future, they're hiring more people to actually create more products, look for additional content, maybe some other acquisitions that are out there. That's a great company to buy on weakness right now. I love ExxonMobil. I also like Ann Taylor in the retail space. I mean, the little black dress is coming back. I mean, you have women that are out there that will take care. Well, I mean, they take care of their kids, little Johnny, for the class picture. They'll go to Gymboree and buy him the outfit. But ultimately, any other discretionary income that's out there, they're going to spend on themselves. And you can see that in the stock price at Ann Taylor.
Ann Taylor's had, Chris, I don't know if you've noticed the storefronts.
I'm very familiar with the storefronts here in Manhattan, yes.
They have completely overhauled their marketing campaign. I mean, they have kind of younger, chicer-looking women now in their ads. It's not so much the
old fuddy-duddy business librarian kind of a look. Yeah, I got you.
It's
all
not
right.
that boxy look anymore. So no, they've had an excellent ad campaign, certainly.
You know what else I thought was interesting too, Todd? You like Charles Schwab. Why do you like the discount broker in this particular space? If we're seeing lighter volumes, we talk about people, money on the sideline. You know, the retail investors aren't really as involved as they once were. Why do you like Schwab in that regard?
All right, I like it for a couple of reasons. One, it's clearly been beaten up this year. I mean, the stock's trading at 14 and change right now. Definitely a great opportunity for investors. But here's why. When you look at the do-it-yourself investor, most of the people that watch this show right now online are the do-it-yourself investor. They probably have an account at an E-Trade, an Ameritrade, at a Schwab. But what Schwab does different compared to all of them is that they will use their cutting edge, their streamlined technology with their options trading and their fancy quote systems and everything else. They use those as a feeder to actually bring people in, to bring in their core holdings. They have their slogan, talk to Chuck. What ultimately they want investors to do is call them up and roll over that 401k money and their IRAs and their core holdings. That's where the real meat and potatoes is in the investment space. The other online brokerage firms don't do that. It's just a commoditized business right now when you look at commissions. So ultimately you need something where you're bringing in those whole assets. If you look at the next 5 years, Chris, over the next 5 years, they expect their commission-based revenue to drop over 20%, but their fee-based revenue will increase over 30%. That is what I'm thinking is the real secret sauce in this right now if you're looking at Charles Schwab.
Hey, Todd, we're going to have to go right now, but real quick as we say goodbye to you, I was looking back at your resume. You've spent years in the financial industry. Your reaction to FinReg passing and how you think that's going to change things. We've got a few seconds.
What? Okay, a couple of things here. One, when you start thinking about FinReg, I was in a meeting yesterday with Argus Research, and their analysts were talking about it. Ultimately, the costs that are going to be involved with FinReg are going to be passed on to the consumer. There's no way, no doubt about it. There's no way to get around that. And ultimately, when you're trying to get new business in, it's extremely difficult in the investment world right now to bring in new business. This just adds another dimension to it. I'm nervous for the industry.
Todd Schoenberger, thank you so much, Managing Director at Land Coal Trading. Great stuff. Thanks.